I'm Mark Steber, Chief Tax Information Officer at Jackson Hewitt, and a personal favorite topic of mine is talking about cryptocurrency investments and how they impact tax returns. As someone who has personally traded cryptocurrencies over the years and followed how it affects the economy and how the IRS is treating these investments, I find it fascinating. Today we're going to cover what cryptocurrencies are, how these investments should be treated on your tax return, if they're even taxed, and how they are reported. And finally, my top mistakes, myths, and misinformation on crypto and taxes. First things first, does crypto count as income? Should cryptocurrencies be reported on a tax return? Mostly yes, but sometimes no. There are thousands of different types of cryptocurrencies like Bitcoin, Ethereum, Tether, Dogecoin, and they are all considered a capital asset, like stocks and other investments, even though cryptocurrency is a form of currency that exists solely in digital form. Because the IRS considers crypto to be property, like stocks, bonds, and real estate, it is subject to taxes when you sell or trade it or earn it, and the IRS wants it to be reported on a federal income tax return. But first, when do you not have to report crypto activity? Well, you do not have to report crypto activity if your sole activity was simply to purchase and hold it. Other than that, stay tuned. If you made earnings from your crypto investments, like gains on sale or trades, or even just get paid in crypto, it will be reported as income. But if you lost from your investment, you might be able to take a tax deduction. Bottom line, you must report all cryptocurrency-related income, gains, and losses on your income tax return, even if the transaction value is low in your mind, and especially if you just did not cash out. That really has no bearing on reporting requirements. Tax rates for cryptocurrency earnings depend on how much income you received and how long you owned your digital assets. For example, if you owned your digital asset for less than a year before selling or exchanging it, you have a short-term capital loss or gain. You'll pay the same tax rate as all of your other income combined, which can range from 10 to 37%, depending on your income level. But if you sell, trade, or withdraw digital assets that you've had and held continuously for longer than a year, this is a long-term capital loss or gain, and capital gain rates are 0%, 15%, or 20%, depending on your taxable income amount. When are there reportable and potentially taxable events in crypto, and how much tax do you pay on crypto? I wrongly hear people think that their crypto investments are only taxable and should be included on a tax return only when they have cash in hand. That's perhaps the biggest misunderstanding in crypto and taxes, and is just not true. With cryptocurrency, it's all about the transaction when you are converting the crypto. This happens during trading, as well as converting one crypto to another. These are all transactions and reportable because it's either a gain or a loss. Additionally, there might be a cash out or disposal of the crypto, but that doesn't mean there's not a reportable transaction with the determination of the gain or loss. What happens when you buy, sell, or trade cryptocurrency with your taxes? When you buy, keep a record of what you bought, how much you bought, the date you bought it, and how much you paid. Most platforms do this automatically, but there are many options and configurations to set and understand so you can follow and ultimately use your data for tax reporting. When you sell, use the information in your records, on your basis or investment in the asset to determine the gain or loss and if you have a long or short-term gain. Long-term gains have lower taxes than short-term. When you trade, you actually have two transactions: selling what you have and buying new. Keep information on all your transactions. What happens with your taxes when you mine or stake or receive crypto as income? Well, when you're mining, anything you find is business income and taxed the same. When you're staking, the value of your stakes are taxable upon receipt. When you sell, the basis is the value when you received the stakes. The sale is a capital gain or loss transaction. When you've received digital assets as income, the value when it was sent to you is your income. When can I write off crypto losses? Great question. Realized losses can be used to offset your taxable investments and profits, and in some cases, even offset regular income. Calculating your losses and gains isn't difficult. It's generally the difference in the price you paid for the cryptocurrency and what you sold it for. Where do I actually report crypto transactions on my tax return? As we discussed, the IRS treats cryptocurrencies as property, so you'll report these transactions using the Form 1040 Schedule D, Line 7 for capital gains and losses. And lastly, you would file a Form 8949 with your Schedule D when you need to report additional information for the sale or exchange of your crypto. If you earned income as a contractor and received payment in digital assets, then you'll report using your Schedule C. If your profit was $400 or more, you'll need to use Schedule SE and pay self-employment tax in addition to income tax. If you received assets as rewards and you are not considered self-employed, then you can report this income on Schedule 1. In summary, there are many ways to get virtual currency assets, from simply purchasing, to earning for services, to trading. Each can have a different tax reporting obligation and tax impact. In all seriousness, this can be a very tricky thing, knowing which tax form to use to report your crypto investments, and it's best to work with a tax pro. How do I keep records of my digital assets? Well, it's so important to keep good records of your finances, not just for tax purposes, but for every aspect of your life. There are a variety of ways to keep records, but do what's best for you, and do it for all areas of your financial planning and record keeping. Don't try to keep some records digitally and others in paper. Things can get lost or forgotten. Have one system and stick with it, and keep up with regularly updating the records. And many of the crypto platforms have the ability to keep data within their system, so it shouldn't be that hard to keep on top of. The world of cryptocurrencies is really fun and interesting, and potentially very profitable, but also risky. And there are changes coming, so be sure to watch out how that will impact your taxes. Changes can include the new Form 1099-DA, used to report all digital asset transactions. But there's so much unknown about the future taxation of cryptocurrencies. I just recommend not pushing it aside and leaving it off your tax return, as the IRS is more competent than you might otherwise think, and failure to report income is not only risky, but also can be expensive. And same for leaving off possible loss deductions, potentially a tax-deductible expense and a waste of a good tax write-off. Still have questions about how your crypto investments will impact your tax return? Well, schedule an appointment to talk with a tax expert today on jacksonhewitt.com. And tell me in the comments, which trading platform do you always recommend to friends and family? And if you found this video helpful, please give it a thumbs up. Subscribe to our channel for more valuable information and hit that notification bell to stay updated on all things taxes.